This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Back in chapter 2, we saw how it was that we had to relate each item, each source of taxable income to a given time period, the income tax year for which we prepared the income tax computation. And one particular problem in that was dealing with trading profits, because a business, an unincorporated trader, whether that's a sole trader business or a partnership, may choose to prepare its accounts to any accounting date that it likes within the year. Businesses do not have to prepare accounts to the tax year date ended the 5th of April. So how is it that we relate each and every and any accounting period for which the taxpayer may have chosen to prepare their accounts to? How do we relate any such trading period to the given tax year in which the tax adjusted trading profit will now be assessed? Now, of course, in chapters 4 and 5, we looked at how it is that we calculate that tax adjusted trading profit, the adjustment of profit process, and what looms large in that overall exercise is the computation and deduction of capital allowances. And it gives rise to the tax adjusted trading profit. Well, let's hope it's a tax adjusted trading profit. In our next chapter, chapter 7 together, we'll see what would happen in the way of loss reliefs if sadly it's a tax adjusted trading loss. But for the moment, if it's a tax adjusted trading profit, how do we relate that accounting period for which the profit has been derived to the tax year? Now, I hope that you'll also remember from back early in chapter 2, we stated what the different bases of assessment for each source of income, including trading income, would be. And what do we say it would be for trading income? We used a term there, we had a little acronym CYB. What did CYB stand for? I hope you're saying current year basis. And what do we then mean by current year basis? What we meant was that for any tax year, that is us primarily, 2016-17 tax year, for any tax year of assessment, we would assess the tax adjusted trading profit of the accounting year that ends in the current tax year. So we're not concerned about the profit period, the accounting period. We're concerned with one date, the accounting year end date. And if that accounting year end date falls in our tax year between the 6th of April and 5th of April, then that is the period that will be assessed. Now, we did some examples then, and you'll find here at the introduction now to this particular chapter that we've got the statements here about how we use CYB, this current year basis here, and we have a little example. If a trader prepares accounts to the 31st of December each year, well, for 2016-17 year, what assessment will be raised? That will be based on the tax adjusted trading profit of the accounting year ended the 31st of December, which 31st of December ends in the 16-17 year, very obviously the year ended December 16. So let's quickly therefore go through a few further examples here in relation to example 1 to just to test out that again we properly understood the current year basis of assessment. Because what is going to make life more, shall I use the word interesting there? You'd probably take that as code for difficult and you wouldn't be wrong. But what we've got to do here is to learn the bases of assessment that will then apply in rather more interesting circumstances. That is when a new business first starts to trade and we have to work out assessments in opening years because current year basis is not going to be immediately available from the first tax year in which the business started to trade. And then what happens in closing years when the taxpayer ceases to trade? There are special rules that need to be learnt, need to be practiced, and that's the way that you will learn them, and we'll deal with that in a moment's time. But to begin with, let's have a look at example 1 here in front of you and look at the normal CYB statement. We're told, part A, Andrew's been trading for many years, preparing accounts to the 31st of March. In which tax year will the trading profits for the accounting year ended the 31st of March 2016 be assessed? Now be very careful. year ended 31st of March 16. 31st March 16. Which tax year does that fall in? Well, that of course falls between the 6th of April 15 and the 5th of April 16. It is therefore assessed using CYB in the 15-16 tax year, year ended 31st of March 16. Whereas if we prepared accounts to 31st of August and we had the accounting year ended 31st of August 16, 31st of August 16 falls in the 16-17 tax year. So using CYB assessed in 16-17. Finally, 30th of April our chosen accounting date and the accounting year end 30th of April 16. Now note there, we started with year ended March 16, that ended just in 15-16 tax year. Whereas you go one more month to the year ended 30th of April 16, that of course ends in 16-17. And as we'll discuss when we get to later on in this exercise, once we've dealt with the basics of opening year's assessments, where we go next, there is of course an original decision that needs to be made when a taxpayer first starts to trade, and that is, so what date will I choose as my accounting date? And exam questions, sometimes the more interesting ones, give you a choice of accounting date problem, and that choice is usually between these two. Should I prepare accounts to the 31st of March, which ends just at the end of a tax year, or should I choose 30th of April, where a year ended 30th of April will end just at the beginning, the end of the first month of the tax year? And that's going to have an impact in relation to, therefore, that choice of accounting date. Is it going to be end of March? Is it going to be end of April? But more of that later. To begin with, we have to learn the basic rules. Then we'll see how to use those rules to answer more interesting problems, such as advising the client of their new business what should be their sensible choice of accounting date. And as I said, that choice tends to narrow in exam questions to a choice between 31st of March or 30th of April. We shall see. For the moment, though, what are the rules, the bases of assessment that apply in opening years? This, by far the more awkward of the areas to deal with. Closing years that we'll deal with later, cessation of unincorporated trades, have got a set rule. We can do it in a three-step approach. It's ever so easy. But opening years is rather more difficult because there's a whole lot of choice involved. The taxpayer decides what date to start trading. Will also then decide what accounting date they will choose to use. And that means that we are going to be looking, of course, to use current year basis, the normal basis of assessment, as soon as is possible. Well, unless you start on the 6th of April and prepare accounts to the 5th of April, CYB is not going to be available in the first tax year in which you've traded. And depending on what start date and what accounting date you have chosen, it could be the second, it could be the third, it could be even the fourth tax year before a valid current year basis is available to be used. And from that point onwards, we will use CYB until we hit the problem of the final tax year when we deal with closing years, of course. So how do we get onto that current year basis? Well, there are rules which need to be learned. Thankfully, the first of those rules is a simple one as regards the basis of assessment that we use in the first tax year of trading. It's the second year in particular that is awkward. The third year may also be a bit of a problem. But let's go through these notes and see what we're told. Now, as we've said here, that there are special rules that apply in the opening tax years until a current year basis of assessment is available to us. As soon as it's available, we will use it. As we've just said, it's not likely that a business starts to trade on 6th of April, prepares accounts to following 5th of April, and therefore CYB would be available in the first tax year of trading. It's not going to happen. Indeed, we will discover, as we've just said, it could be up until the third or even fourth tax year of trading before CYB will apply, because for it to apply, there must be an accounting year. Not a 6 month, not a 9 month, not a 14, 15 or 6-month period, 16-month period, but an accounting year. An accounting year ended in the tax year that will allow CYB to apply. HMRC, of course, do not wait around until the first tax year in which you have a valid current year basis before they're going to start to assess you. From the day you start trading, whichever tax year that falls in, they're going to tax you on any profits made from the first tax year onwards there. The question is, what basis of assessment will they use? Well, in the first tax year, there is no choice. It's a set rule, and on that basis, therefore, it's pretty easy if you learn the basic rule, that is. The first tax year, we will use an actual basis of assessment. What does it mean? We will assess the profit that is actually made from the date the trade commenced through to the following 5th of April. So actual basis of assessment in the first tax year means the trading profit, again, we're using tax-adjusted trading profits of the business here, from the date you started trading through to the following 5th of April. Now, inevitably, as you'll see within the note, that is going to involve some sort of apportionment, because it's unlikely that we will be preparing accounts to 5th of April, or for that matter, 31st of March. 31st of March, we do the apportionments here of our profits to the nearest month. It's on a monthly apportionment basis. So 31st of March equates effectively for that apportionment, that calculation exercise to the 5th of April. Now, it may well happen, and a choice of accounting date question would involve that, and we'll see it in our exercises soon. But again, it's unlikely that we're going to have CYB available in the first year. We may not even have it available in the second tax year. So it's that second tax year where things start to get, again, shall we say, more interesting. Because, again, there's going to be choice. Not that it's a choice for the taxpayer to say, well, shall I have that or shall I have that? It will depend on the specific situation that they're in. So we, again, have got to learn rules as to know, to determine what basis period, what basis of assessment will apply in that second tax year. So let's look at the summary now over on page 42 here. As again we've said, for the first tax year, it is always actual. That is, profits from the commencement date, the day you commence trading, through to the following 5th of April. Inevitably, as we'll see with a little example in a moment, that is going to involve some sort of time apportionment exercise of a profit period. But then in the second year, we start by asking ourselves a question. Is there any accounting period at all that ends in that second tax year? Now, if you were really lucky, you would not only have an accounting period that ends, but the particular accounting period that ends would be a year end. And you know, if you have an accounting year ended in that tax year, what basis of assessment will apply? Current year basis. Your problems are over. You've gone from actual onto current year basis, and you stay with current year basis, and then until you cease trading. But what we may have is an accounting period that ends in that second tax year, but it isn't necessarily going to be of 12 months. It could be a short period ended, it could be a long period ended. And of course, the other possibility when we ask the question, do we have an accounting period ended in that second tax year? The answer is simply no. We don't have any accounting period. So each of these circumstances has to be dealt with and has to have a separate rule. We don't get to decide which profits will be assessed for any tax year. There is a rule. HMRC say you do it our way. This is our way, and we have to learn those rules. So what have we got here? Looking back to your notes now again on page 42. Assuming that, yes, we do have an accounting period ended. The question then is, how long is that period? It may be a short period, our opening accounting period, may end in the second tax year, but be of less than 12 months. It may be a short period, less than 12. Or, if not less than 12, it may either be exactly 12 months, which would be great because that would be current year basis available to us, or it may be more than 12 months. So how do we deal with each of these two circumstances? Let's deal with this one first. Yes, we have an accounting period that ends in that second tax year, but it is a short period that ends in that second tax year. We need, of course, to stop just talking about the rules and apply those rules, for which we need an example. Okay, make a note of the following information, please. We're told taxpayer start to trade on the 1st of January 2017 and prepares accounts. You'll be pleased to hear they do prepare accounts to 30th of September. Okay, so we started therefore on the 1st of January 17, prepare accounts to 30th of September. So our first period, period 2, the 30th of September 17. Now look at the length of that period. It started on the 1st of January and it goes through to the 30th of September. So that opening accounting period is a short period. It's a 9-month period. And what we're told is that the tax adjusted trading profit of that period, so we've done the adjustment of profits, we've computed and deducted capital allowances, we've got a tax adjusted trading profit of that accounting period to the 30th of September 17. And that figure works out to be £36,000. Having now chosen our accounting date, we then have our first year end, the year ended 30th of September 18, where now the tax adjusted trading profit is £60,000. Now from that point on, current year basis would be available to us and we will use it. So let's see how it is that we now establish for the relevant tax years for which these profit periods are involved, the relevant tax years, what the assessments are. Now again, if this were to come up either in a section A, a section B or a section C question, then although only in section C are we involved with demonstrating and showing our presentation of our workings there, you're still going to have to know what is the relevant tax year, what is the basis of assessment, what is the basis period. So I'm going to show you how to draft out an answer to a problem of this nature here, as you would for a section C question. But you still have to go through exactly, ooh, I've got a sneeze coming up. Ooh, oh, we're okay. Exactly the same technique would have to be adopted whether it was a section A objective testing question or whether it was a section B objective testing question. So follow the technique. Right, step 1. Always pick up your start date, 1st of January 17. And that tells you what is the first tax year. So you tell me, it's going to be difficult to know, but have a little think. What do you think, therefore, is the first tax year? What tax year does the 1st of January 2017 fall in? Between which 6th of April and 5th of April does that start date fall? Very obviously, I hope you think you will agree here, that is going to be the 2016-17 tax year. Now, please be very careful on this. Often students see, oh, if we started in 2017, then the first tax year will be 17-18. No, it doesn't work that way. Look at the tax year in which you started to trade. 1st of January 17 falls within the 2016-17 year. Now, what basis of assessment do we use in the first tax year? No choice here. It is actual. The actual basis of assessment means we look at the profit period from the day you started trading, that was the 1st of January 17, through to the following 5th of April. That therefore is the 5th of April 17. Now, in terms of the apportionments, the calculations we do it to the nearest month. So we don't have to worry, therefore, about the 5 days of April. So we've got January, February, March, 3 months. And that's going to be 3 months here, drawn from that opening period to the 30th of September 17, which, as we said, was a 9-month period. So the calculation now, 3 ninths, 3 months, January, February, March, out of the 9-month period to September 17, 3 ninths of £36,000, and that therefore will give us £12,000 as our assessment. And the first part of the task is performed. We now know that the assessment for the first tax year, 16/17, is £12,000. Now look again at the process and the presentation. We've identified firstly the starting point of what was the first tax year. We've then stated, we've told ourselves, as well as in a section C question, the examiner, that the basis of assessment is actual. We've then defined that as the basis period. The basis period, what does actual mean in 16/17? From the day you started trading through to the following 5th of April. And then we've shown the calculation of that. 3 ninths times £36,000. Now, all of that must be presented if you're dealing with a Section C question. Not the least because this work may be follow-on work from, for example, establishing for the opening accounting period that tax-adjusted trading profit. I've given it to you, 36. I've given you the 60,000. We use those numbers now in determining the assessment. But an exam question, a possibility is, here is a statement of profit or loss for the opening 9-month period. You've got to adjust up that statement of profit or loss with the add backs, deductions, your zero adjustments, whatever is necessary there. You had to compute and deduct the capital allowances for that period as well and derive the tax-adjusted trading profit. Now, I've told you it's 36. If you've had to work this out for yourself, it's just possible that along the way of the adjustment of profits, the capital allowances exercises, we may have made a mistake. In which case, the number that we get is not the figure as per the model answer. So it means that when you use that number in your assessments, the end assessment does not agree with the model answer. So that is why it is essential that you show the examiner how you have worked to that assessment figure there. And how you've done it is, what's the tax year, what's the basis of assessment, what's the basis period, and there is my calculation. And if that 36,000 happened to be the wrong number, because of something that I've done earlier in the question, the examiner, the marker, can easily follow through what you've done and see that this is absolutely correct. And you can therefore get your full marks available. If all you've done is ignore all of the information that has preceded this and just said first tax year and put in 11,000, 13, whatever figure based on your numbers, then it's wrong. You've not given the examiner the basis to determine whether or not you've applied the right technique. And don't expect the marker to get his or her calculator out, go back to your tax-adjusted trading profit and try to work out, well, does that number that you've put in there, would that, using the correct basis of assessment, be the right figure? If you can't help yourself, why should they bother to help you? It's not going to happen. So you show, you demonstrate, therefore, the correct presentation of this. Clearly, if it's part of an exercise for objective testing, you've just got to make sure that you get the right answer, and therefore, as long as you know what you're doing, you don't have to write all this out. You just need to get the right answer. Right, first tax year, 16/17, actual basis, we've now got that assessment here. Right, we now move on to the awkward one, the second tax year. Now, if the first tax year is 16/17, our second tax year must be 2017/18. Now, look back at your note And what does it say for the second year? Question. Do we have an accounting period that ends in that tax year? So do we have any accounting date ended in the 17-18 tax year? Look at what we've got here. Do we have that? I hope you can see that, of course, yes, we do. There we have the accounts to the 30th of September 17. That therefore ends in the 17-18 tax year. So answer, do we have an accounting period ended in the second tax year? Yes, we do. Second question, how long is that accounting period? If it's not a year, is it short? Is it long? Is it less than 12? Is it more than 12? How long was this period? It was a 9-month period. Therefore, look back at the note in the chapter. What basis of assessment do we use where there is a short accounting period that ends in that second tax year? That basis of assessment, as we should know there, is we take the profits of the first 12 months of trading. So, basis of assessment stated, basis period. First 12 months of trading means from the date you started, 1st of January, through to a date 12 months later, that would be the 31st of December. So again, the 3 basic things you need to know before the calculation can be done. What's the tax year? 17-18. What's the basis of assessment? First 12 months. Basis period, 1st of Jan to 31st of December. So what therefore goes into that? Well, that first 12 months clearly includes all of your opening period. So you got all of your opening period, that was the £36,000 for the 9-month period to the 30th of September 17. We need another 3 months, and that remaining 3 months is 3 months out of the 12 months of the second accounting period to what was the year ended September 18. What was that profit figure? I think that was 60,000 there, if you just check back. It was £60,000. So we take 36,000 plus 3/12 of £60,000. 3/12 of 60,000, that's going to be what, 15,000 plus 36. We're talking £51,000 as the assessment in the second tax year. So to repeat, second tax year, do we have an accounting period ended? Yes, we do. It's 30th of September 17. Therefore, how long is that period? It's a short period. It's less than 12. It's a 9-month period. So what do we take? All of that opening period of profit plus however many months worth out of the second period of profit. It will always be for a year. However many months of that year that we need to boost this up now to 12 months. 36,000 was 9 months. We need another 3 months. We take 3/12 of the 60,000. Assessment 51,000. Job done. 2017-18, we now have our assessment. We move then to the third tax year. That now must be, as we move on through the tax years, 2018-19. Now, by now, we're hopeful that we will at least now be able to use CYB. So question, do we have an accounting year ended in the 2018-19 tax year? Do we have, again, an accounting year ended in that tax year? Answer, yeah, we do. Therefore, current year basis applies, it being the accounting year ended the 30th of September 2018, for which we had a tax-adjusted trading profit of £60,000. Tax-adjusted trading profit, £60,000. Okay, you're now on to CYB. You will stay with CYB thereafter until such time as you meet the final tax year, and we deal later with the basis of assessment in closing years. Now, having applied those rules, something might occur to you now which you may think to be a bit of a problem. Because what we see is that In the second tax year, we have included 36,000, the profits of the entire opening 9-month period. But we've already included 3 months worth of that profit in the first year. And then in our third tax year, we've used all of the year ended, all of the year ended September 18 profit of 60,000, having already used 6 months worth of that profit, 3 months worth of that profit in the 2017-18 tax year. Now, you might start thinking, hang on a minute, is that fair? That's not a word you want to use in relation to tax. Don't use the F word, fair, there in relation to tax. What we've got is a perfectly reasonable circumstance, but it does happen that some parts of our profits in opening years will fall into more than one tax year. Don't get caught in that emotive expression, well, you're being taxed twice on a figure of profit. Don't go down that route. Look at it this way, that in that opening tax year, you traded for 3 months. In the 2016-17 year, you traded there for 3 months. And how many months worth of profit have you been assessed on? Answer, 3 months. In then every remaining tax year from that point, you were traded for 12 months. How many months worth of profit have you then been assessed on? You've been assessed on 12 months of profit. You have been assessed on 12 months worth of profit. So we've assessed in the first year where we traded for 3 months, 3 months profit. In every subsequent year, you've traded for 12 months, you've been assessed on 12 months of profit. It just means that in moving from an actual basis in the first tax year onto current year basis as soon as you can, here it was the third year, that periods of profit have fallen into more than one tax year. This is not unfair. But what does happen, HMRC do indeed take account of this fact. And what we do is to compute what we refer to as overlap profits. We look at what figures of profit fell into more than one tax year. So we compute those overlap profits, and what we do with them, we will keep those overlap profits noted until, at least so far as our syllabus is concerned, the business ceases to trade. And on cessation of trading in the very final tax year, we will deduct from whatever the assessment would otherwise have been the amount of overlap profit that arose during the opening years. So we will credit back in determining the assessment for the final tax year any overlap profits that arose in these opening years. So it's accounted for, it's dealt with, it's credited back. So there's nothing unfair about this system. Right, all we now need to do is to calculate what that overlap profit is. Now, we've got lots of circles and lines on our answer here, but let's see if we can see what that overlap profit would be. Now, 12,000 being 3/9 of the £36,000 there, 3/9 of that, 12,000 has been assessed in the first year. That £12,000 is a part of the £36,000, the full 9-month opening period profit that was assessed in 17/18. So there is the first part of your overlap profit, £12,000. So in calculating now, our overlap profits, the first part of that calculation was 3/9 of 36,000 that was assessed in the first tax year and was part of the assessment for the second tax year. So that therefore was £12,000. Where do we also see some overlap? Well, of course, we've now got that 3 months of the 60,000 being assessed in 17/18 and is of course a part of the overall 60,000 assessed in 18/19. So there, therefore, is the second part of our overlap, that being 3/12 of £60,000, and that is 15,000. Total, therefore, in relation to our overlap profits, 12 plus 15, £27,000 worth of overlap profit. That is noted on our permanent tax file at this point in time. And what do we do with it? Well, it'll come back, of course, to be deducted in deriving the assessment for the final tax year. Now, we've seen there the specific makeup of the overlap profit. Another way by which you might choose to compute this is this. If we look at, in terms of the information in the question, what profits arose in those accounting periods? 36 plus 60, well, that is £96,000 worth of profit. So we actually made, in the first two periods, £96,000 worth of profit. Those profits have then been used to determine the assessments in the first tax year, 16-17, the second and then third tax years. In those periods, what amounts have been assessed? We've assessed 12,000 plus 51,000 is 63,000. 63 plus 60, add up those three figures, that, I think, will equal £123,000. So the actual profits that have arisen, 96,000. What have we assessed? We've assessed 12, 51, 60 in total, that therefore 123,000. What's the difference between £123,000 assessed and the actual profits made, 96? That, I'm very relieved now to see, comes to £27,000. So there we go. We have proven in our terms of our calculation that overlap profit. So either way is acceptable in terms of establishing the overlap profits. So you've got to know how to calculate it, and you've got to know what happens to it. It's going to be used to reduce the assessment in the final tax year. So to repeat, therefore, what we've just seen. In opening years, we are going to work from an actual basis of assessment that always apply in the first tax year to a current year basis as soon as we are able. That's going to be the second year or the third year or possibly even the fourth tax year before that will be available to us. In getting us from actual to CYB, there are then different rules that apply depending on the specific circumstances. The second tax year is the most awkward one. If we have an accounting period at all that ends in that second year, how long is it if, as in this example, it is a short period that ends in that second tax year? Then the 12 months of profit to be assessed is very specifically the profits of the first 12 months of trading. If it's a Section C written question, get all of that information noted in the way that we have. What is the tax year? What's the basis of assessment? What's the basis period? And then show the calculation to derive your assessment. What we'll then discover, depending on your choice of accounting date, is that we may have an overlap profit to compute. We've seen how we identify the overlap periods and therefore compute what those overlap profits are, and we know then what happens to them. What we'll therefore see in our next lecture together on this particular chapter is, okay, we've seen there that if we have an accounting period ended in that year, it happens to be a short period, how we deal with it. What would happen if either in the second tax year there was a long period that ended in it, or there was no accounting period ended at all? Those are the other two remaining options that we need to exhaust, that we need to deal with, and we'll deal with those in our next session together. Make sure before then that you are again happy with the work that we have done so far.